All right, let's go ahead and get started. Looks like we have a majority of people on. Just do one thing real quick. Okay. All right. Thank you for joining us for the Around the Valuation World International. My name is Chinda Chun and I'm with NACBA and GACBA. Before we get started, I just want to go over a couple of items. First, to obtain CBA credit, you must answer all the poll questions that pop up on your screen during today's webinar. You must, let's see, CPG students will appear on your nacb.com account after 7 to 10 business days after today's webinar. If you have questions during today's webcast, please use the Q&A option in Zoom to ask the presenter questions. If you have any technical questions or questions about NACBA, please feel free to use the chat feature as those will be directed to me. Today, these are our technical editors, and today we have Andrew Newman and Pratik Shah who will be joining us. Beginning, we'll just take a few moments to talk about some GACBA items, and then we'll turn the time over to Joe Orlando, who will talk about business valuation in the wine industry. Just really quick, before we start, like I mentioned, we wanted to talk about some of the benefits of membership. Here is a link to show you the benefits. Let me just go to that web page real quick. Can you see the website, Joe and Pratik, or do you still see the slide? That's what I thought. Let me share it a different way.
Yeah, I still see the slide.
Okay, that's what I thought. There we go. So with the benefit of membership, if you go to this page, you will see all of the benefits that we offer our members, like the Econassist and the key value data. Different resources that are available to you. We do have the publications that are actually included in your membership. Valuation World is one of them. You're able to view it monthly. There is a CPA subscription if you are interested in that. Along with the credentials and the practice support headquarters and mentor exchange, some other different options and resources that are available to our members. So I do encourage you to take a moment to view that and get familiar with some of those items that are available to you to help you out. And then with that, I'm going to turn the time over to Pratik and Joe. And yeah, we'll get started with today's presentation.
Hey, hi everyone. Good morning and welcome to Around the Valuation World on behalf of GACBA and NSCBA. So, as a part of introduction, I'll first quickly go over. I would like to welcome and thank Joe Orlando to be part of the session today. So just to give a brief background about Joe, so one is definitely my first mentor, and he's an ASA and is currently Vice President for Exit Strategies Group, a mid-sized business valuation and M&A brokerage firm serving the Western US. Joe leads Exit Strategies business valuation practice, working primarily with private companies and owner-operators in all industries with a strong focus on the craft beverage space. He has, I think, close to 30 years of experience. And prior to Exit Strategies, he was part of, he led practice for Frank Rimmerman, one of the growing Northern California accounting firm. And prior to that, he was part of Silicon Valley Bank Analytics Group. With that, Joe, I don't want to take much time on the introduction, but, over to you, Joe, and welcome again on Around the Valuation World.
Thank you for inviting me. I appreciate the opportunity to present my first global presentation, and I'm excited that it's on the wine industry. So first of all, can everybody see my slide?
Yes, we can, Joe.
Yes, we can see you.
Oh, good. Okay. So today I have an agenda to talk about the wine industry, and an industry that I focus my time on, and one that I thoroughly enjoy, not just drinking it, but actually going on site and visiting wineries and seeing how the wine gets made. So I'm going to start out with some wine industry characteristics, and then really dig into what we're all here about, which are general wine valuation issues. I have a slide that I have a poster of in my office called Wine Math that I've actually taught to students at Linfield University who were going through the wine business program there. And I think it's a good picture for people to understand how wine gets produced and what the math is surrounding harvest and what goes into a bottle of wine. Then I'll dig even further into wine financial statement analysis and look at the three pillars of valuation methodologies: the asset approach, the income approach, and the market approach. We will dig a little bit further in terms of asset heavy versus asset light wineries. That distinction will be clarified later on in the presentation, but there are different methodologies for those different approaches to value for those types of wineries. And then I'll open it up to questions. This is just a slide that is a little bit more detail that Pratik outlined. And so when you get the slides later on, you can read a little bit more about it. You can see my picture is a little bit dated, but I look a lot better in that picture than I do now. So some wine industry characteristics. Wine industry is a fragmented industry, especially in North America. There are about 8,000 wineries, about 35,000 worldwide. In many ways, it's a family business. It is a big family business. It's not like the corner grocery store, but it is family. Most of the wineries that I deal with are family run. There is a strong corporate presence for consolidating some of these wineries. And but even one of the biggest wineries in the world, which is Trinchero and Sutter Home, is owned by the Trinchero family. It's capital intensive. It's typically based on the acquisition of land, vineyards, cooperage, which is the production of the production equipment, and the crush pad associated with crushing grapes into juice and then making wine. One of the things we're going to talk about is that it's greatly affected by nature. So climate change definitely has an impact on this industry. Weather is highly unpredictable, and it adds to the complexities of forecasting. There is never a winemaker that says how the harvest went until well after the grapes have been picked. They look at yields, they look at quality, they look at and it's not just the day of picking or the day of crushing. It does not have very strong visibility in terms of the main ingredient, which are the grapes. And it's highly correlated to changes in the economy and discretionary spending. What we saw in COVID was that there was a significant increase in spending on wine. What we see in recessions is that people trade down between price points. So they go from a $15 bottle to a $10 bottle. So it's highly correlated to the economy and the amount of money people have to spend. There's strong global supply and demand from emerging markets, whether it's China, whether it's Europe. I mean, it is a global industry, and the brand is something that is significant with regard to the wine industry. Wine critics and influential consumers impact sales and success. And wineries try to game that system in some respects by getting key influencers to taste their wine and review on it. There is a significant brand association with celebrity now in terms of the wine industry. The Wine Business News just announced that Snoop Dogg just introduced a new wine. I would have never seen that press release 5 years or 10 years ago. And there is a lack of solid, consistent financial data to analyze the industry. And a lot of that is this is a private industry. There are very few publicly traded companies, and more importantly, the wine industry holds information close to their chest in terms of what they produce and what the price is for transactions and valuations. So it is the approach to valuation is very fundamental. But if you have the ability to do a survey of investment bankers, or if you've worked on winery sales, you have the ability to have a little bit more visibility in terms of exit multiples. Looks like we have a question. I understand.
Yeah, Joe, we just have the poll question. The first one is launched.
Okay.
You can just continue with the presentation.
Yeah, sorry about that.
Yeah, not a problem at all.
So like I said, traditional valuation methods are used. They can result in a wide range of value. There's a mix of assets. We talked about asset heavy and asset light. What's listed here, the last three are asset heavy. The first one is asset light, brand and inventory. Closely identified with an individual, family, and legacy we talked about, and really the scope of the valuation. So I may be doing a valuation for estate tax purposes. I may be doing one for gifting. I may be doing one for strategic purposes. It's in many ways the difference between fair value and fair market value when you look at a willing buyer and a willing seller. If you look at fair value, you include market participants. If you look at it from a strategic value or most probable selling price from an M&A perspective, you're trying to take into account synergies associated with a very strategic buyer. Oops. Let me see here. All right, so this is my chart on wine math. I'll let you review this at some point in time in the future when you get the slides, but it's a very interesting path to a single grape and a glass of wine. And so this not only looks at the math associated with it in terms of how many vines per acre and how many clusters per vine, but it also looks at what's in a 750 milliliter bottle, and at the end it says that one glass of wine equals 8.4 clusters or 630 grapes. And so it's a very interesting slide that you can hold for future reference when you think about the wine industry. So basically what that chart outlined in a very graphic way was the supply chain associated with the wine industry. From grape to bottle, there are many people that touch the product and add value along that supply chain. So the saying is good grapes make good wine. Weather drives yield. From a risk perspective, the winemakers and the vineyard managers and the AVA, or the location at where the grapes are being grown, has a significant impact on the quality of the grapes, and so that is a key aspect of value along the chain. A good winemaker can make good wine out of good grapes, but great winemakers make expensive wine out of good grapes and cult wine. And so there is a significant increase in value associated with the purchase price, or the price per bottle of that wine, when it has that cult status. That sales and marketing is definitely along the way in terms of what that image is in terms of selling that brand. And the distribution has a significant impact on the value of not only the bottle price, but also the value of the winery. So a business that sells its product, or a winery that sells its product direct to consumer, is able to capture that markup and sell at a retail price. If they're selling through distributors who are selling that wine to supermarkets, and the consumer is buying that wine at the supermarket, the winery shares all that incremental profit with those distributors, but it has a significantly less cost associated with selling the product direct to the consumer. So there are some points along the way here that show that some of these points have different margins that go into the costs associated with that risk and the return associated with that risk. And so it's just a very simple graphic to show that at all different points along the chain, there are different margins for different spending. I like to use this chart as a, this is very similar to early stage technology companies in terms of startup and development in many ways. And I had a presentation with Sam Renwick talking about the wine industry and life sciences and the similarities between the two. The simple truth is that that it takes a long time to go from a blank canvas, which is a piece of land that doesn't have vines on it, to a bottle of wine. Those vineyards need to be planted. Those vineyards need to be matured, and then when the grapes are finally picked, that wine needs to be aged. And so there is probably a 7 to 8 year period, depending on what kind of wine you're making, that will suggest that if you go into this business as a landowner and decide you want to plant vines, there's going to be a significant capital outlay that's going to happen before you make your first dollar. So this is a good way to look at wineries from a valuation perspective as well, in terms of early stage versus later stage companies. So excuse me, winery financial statement analysis is really similar to every other wine industry, every other industry, in terms of looking at data and trying to identify things that you can pull from that data. What I like to call nuggets of information that lead to value, at least in the way in which I look at a business. The asset mix, the size of the business, the stage of the business, like we just talked about, how it's capitalized, what their cost structure is. They're pricing their margins and profitability, but not only for the company, but how it compares to its benchmarked industry. Its distribution channels, whether it's 100% direct to consumer or 100% direct through wholesale suppliers, depends on or decides really what drops to the bottom line. Whether you own your vineyards or purchase grapes, and whether you have custom crush. A custom crush is basically a business that either has the cooperage to allow winemakers to take grapes and make them into juice at a facility that the winemaker does not own. They pay a higher price for that service, but they don't have the investment cost of building out their own crush pad. So there are ways in which a winemaker can variabilize expenses as opposed to investing in hard assets. So this is a sample balance sheet. Traditional business, has and this is asset heavy. So when I mean asset heavy, I mean that it's a traditional business with vineyards, on-site tasting room, a primary and possibly a secondary label, and debt associated with the business in terms of building out those assets. The biggest asset is the wine inventory. On the current side, wine inventory is effectively wine that's in bottles or in barrels that has not been sold yet, and it is for most businesses their lifeblood. It also gives them the visibility as to what they can sell in the future. You can't sell inventory that you don't have, and so there is a significant planning that goes into production and inventory that looks forward in terms of what anticipated demand is when that wine matures to a point of selling. For asset heavy business, there is significant property, plant, and equipment associated with the ownership of the land, associated with the vineyards. That is the primary asset for the business overall. It is a long-term asset, and it is something that really allows the business to take advantage of depreciation, amortization with regards to some of the intangible assets associated with the land. So there is an accounting standard in the U.S. that allows vineyards to identify their AVA, or agriculture, or American Viticulture I forget what AVA means, the acronym. I apologize. But that intangible asset is different. So if there's a vineyard in Napa as opposed to a vineyard in central California, the value of that location has a significant value in Napa, given the ability to sell wine at a significantly higher price point for grapes that are grown in Napa. So that intangible asset goes towards that gets amortized as well. That's what that other asset is. Basically, it's the value of the geography of the land. Liabilities are simple liabilities. The business has payables just like any other business. It has related party debt, and it has significant equity. So you see the beginning balance is significant. The business is making money, at least in this example. And so, we usually see businesses that are either break even or losing money. It's it's a business that has a very wide range of performance based on the ability of the winemaker and the ability of the family to run the business, or the cult status or reputation of the wine. So we see profitability all across the board. That profitability here is, on an asset heavy winery. You see that, this example has revenue of about 13 to 19 million on a forecasted basis. The margins are in the 50%, which allows the company the ability to cover a lot of its operating expenses with margin that's higher than it would be if they were subcontracting or doing a custom crush. Because they own the land here, they effectively have the grapes at cost as opposed to retail. So they're not going out and buying grapes on the open market or through contracts with vineyard owners that build in a profit for that cost associated with growing. So those are the advantages. There's vertical integration, so control of access to grapes to consistent standards. The winery story includes a terroir. The terroir is simply the land that the wine grows on. The ability to sell an estate wine, the quality control associated with those grapes, and not selling grapes that are not up to that standard. So there's a lot more control when you own the land as opposed to when you buy the grapes from a third party. The disadvantages are that the key assets are intertwined and not necessarily separated. So it's difficult to just carve off a part of this business. It's a very integrated business. There is a need to reinvest in these hard assets, and the corporate structure may not be conducive to outside investors to do that, because it's a family-run business, which are usually pass-through entities or LLCs. In the case of public companies, there is the ability to get investors. There are a few, Duckhorn, Willamette, a few other treasury wine estates that are public companies that can be invested in. But that family ownership also makes for muddy exit scenarios and a decision to sell. So there is family drama in every industry that has family participants running it, and so the wine industry is not immune to it. But you see in this case the EBITDA is significant. We're talking about EBITDA in the 20% range, and or higher. This is a realistic model. It's not a model that occurs for every winery, but it certainly is realistic. And some wineries kick out 30 to 40% EBITDA, which really are the ones that have cult status and can sell their bottles for direct to consumer for north of $200 to $300 a bottle, not just not a case, a bottle. So this asset light model is a little different. And so the asset light model has similar inventory issues. I mean, not issues, but similar inventory assets in terms of the wine that they make. It's just that they make the wine from grapes that they buy from other vineyards, and they may produce at a custom crush facility. Their property and plant and equipment is not necessarily focused on long-term assets such as land and land and buildings, but mostly on equipment and other things that it needs to invest in order to run a tasting room. Excuse me for a second. Those other assets are minimal because they don't own the land, so they don't have that AVA opportunity. The other parts of the business are pretty straightforward, but one of the things you notice is that the equity equity is significantly less. So you can start a winery, a virtual winery, an asset light winery, a lot easier than you can one that requires land and purchase vineyards, and the investment is significantly less, but the upside is less as well. That income statement is similar in that it's a profitable business, but the margins the margins are a little bit higher in this example because of the ability to increase the value of the brand, but the margins traditionally are a little bit higher depending on the costs of farming the grapes on the asset and the asset heavy business. The advantages of having this asset light is that it's a nimble business model. Really what you're selling is brand and lifestyle and a brand portfolio that mitigates risks over a good number of varietals or brands. So this business, for example, may have one or two brands that aren't associated with a family, that have a lifestyle attached to it, a lifestyle sort of a goal attached to it in terms of what they're trying to sell. There are more grape contracts, and so there is a significant need to manage those contracts and make sure that you have access to grapes that are consistent. And so you need to sign long-term contracts with vineyards. Some of those long-term contracts may include taking over the farming of that property as well. And so that's something that vineyard owners are fine with, having people come in and farm their land at a cost, and it gives the asset light business the ability to have a little bit more control over the land. But the biggest asset here for this business is its inventory and its brand from a tangible and intangible perspective, respectively. So this is the comparison. That asset heavy balance sheet is a portfolio of assets that mitigate risk over different types of assets: inventory, tangible and intangible assets. Heavy assets allow for collateralized debt and greater financial flexibility, but they require significant investment. Brands attached to a family legacy in most cases in the geography, and has a longer staying power in that it's not something that has a sort of a flash in the pan type of aspect to it. The fact that you can control the growing and the quality of the grapes allows that brand to live a little bit longer. There is the ability to increase revenue streams through utilizing excess capacity. So, for example, a winery that has a crush pad and a license that can produce twice what it produces on its own can go out and find other winemakers to use that crush pad and generate revenue for the company for excess capacity that it has. There is also an opportunity to increase operating margins through cost control. Some of the things that we do from valuing small wineries is normalize expenses. And so we find that some of the expenses are not necessarily what a normal buyer or a financial buyer would pay. Some of those salaries are either high or low, and some of the people that are being paid are not necessarily key to the business. And so I kid all the time that it's like having grandma on the payroll, because she sits in the tasting room and greets everybody when they come in. That may not be necessary to run the business from a financial perspective. The exit scenarios are less flexible because there's a significant portfolio of assets, but more importantly, the purchase price is higher, and it eliminates some logical buyers who want to own that business but can't afford it. Whereas they can in the asset light business, because it really is a portfolio of brands. The tangible asset is the inventory, the intangible is the brand. Those assets require, personal debt guarantees and limited financial flexibility, but they also allow you to get into that business with less capital. There's quality contingent on access to grapes, so that's an important aspect of that model. And cost control is more difficult because you're dealing with an ecosystem of interested parties. You really can't control the cost of a wine of a grower's farming costs, and the inflationary pressures on this industry are significant across the entire supply chain. Ownership structure is built for sale and ease of a third-party investment, and the opportunity to take multiple bites of the apple is very frequent. And so there are a lot of brands that will, or a lot of holding companies that have different brands that will sell off brands and then create new brands and sell those off again, or sell off the new ones. And so this model, if it can be replicated, is a very profitable one. Pratik, do you want me to stop, or do you want me to keep going?
I think we have a couple of questions, so we can take that up right away. So
Okay.
The first one is from Carrie. The question says that how would you approach the valuation if the owner of the winery doesn't want to sell the land along with the winery, rather they want to keep the land and lease it to the buyer?
Yeah, I mean, that structure is all built on. What you've identified is a scope of work that that is easily doable from my perspective. What I think the winery would ask for is not a valuation of the winery, but a valuation of the brands. We wouldn't necessarily value what that contract may be in terms of leasing back that land, but we see that all the time. One of the biggest wineries in Sonoma, where I used to live, had a similar sale. The Sebastiani family sold a brand portfolio and kept hold of the vineyards and the tasting room, and leased it back to the buyer of those brands, and eventually sold those the remaining assets to the same company, but held on to them for a little while. So it really depends on the scope of work and how you define it.
Thank you, Joe. So the second question is from Tom. So when you talk about asset light, are you talking about a Cameron Hughes type model?
I'm sorry, a what type model?
When you talk about asset light, are you talking about a Cameron Hughes type model?
Okay, let me see the question. Hold on a second.
Sure.
Who asked the question?
It's Tom.
So Cameron Hughes is not a name that I'm familiar with, and so I apologize. I'm a homer when it comes to knowing wine brands. And so what I mean is I really focus on wines within the California, Oregon, and Washington area. And so if Cameron Hughes model is one that's more of a portfolio of brands, and yes, it is very similar to that. There is the asset light approach is really an approach that strong marketers follow in terms of individuals and teams that can create brands from nothing, market those brands, get people to buy those brands, and then eventually sell off those brands to bigger companies that can grow that production even further.
Yes, so I think Tom just put some points as well. So he's saying that Camden Hughes used to sell a large amount of stuff through Costco,
Oh,
and he
okay.
was more of a negotiator. So
Yeah, so it is similar. It is a similar model. Some of those models that sell in high volume at Costco are also asset heavy businesses. So Willamette sells through Costco, and Willamette has significant assets in the Willamette Valley in Oregon. Vineyard assets and production and tasting room assets, but and that's a public company, so you can see a little bit more about what that company has on its balance sheet than you can for any a private winery. But yeah, it is someone that sells at Costco is trying to capitalize on the value of a brand and sell it at a high volume, and ideally capture significant income through volume, as opposed to selling it direct to consumer and incurring those sales and marketing expenses.
we'll take another couple of questions before you enter the next phase. So question is from Philip. How is the valuation approach different in the case of winery that enjoys broad national, international distribution versus smaller destination winery with sales that are primarily generated on site?
How are those valuation approaches different?
Yes.
Well, in some respects, not at all. I mean, cash flows are cash flows. Where it comes from may or may not be, from my perspective, are not necessarily as important as how to look at things relative to the asset base. So the winery that is more focused on a destination location and selling direct to consumer through Wine Club probably has their own estate, their own vineyards, and so I would lean more towards an asset approach as a primary asset for valuing that. Whereas one that's global and has strong distribution across all lines is likely going to have a value that's more conducive to an income and a market approach.
Yeah. So one last question from Kevin. So it says, do your comments change significantly in terms of approaches, asset structure, etc., if you are talking about a distillery versus a winery?
No, it's a good question. So I value craft beverage, and I have valued distilleries, cideries, breweries. The difference between wineries and all other craft beverages is the control of the greater control of the asset, and so greater control of the ingredients that go into the production, and so. A distillery has got significantly less risk when it comes to weather and production. And so, for example, that inventory turns significantly more often than a winery, and the ability to meet increased demand is significantly easier for a distillery because of the ease of production, the ability to produce over different periods of time across a year. Whereas in a winery, harvest here is in September through November, and they're not picking grapes in March, and they're not producing. They may be bottling, but they're not even thinking about production until 6 months from there. And whereas a distillery, a brewery, or a cidery can be a little bit more flexible with regards to meeting increased demand. So the approaches are probably a little bit different in that I would look at an income and a market approach, and give the company some credit for the ability to be flexible and meet a more aggressive forecast that they may not have the visibility of in their inventory. But a winery that has $5 million worth of retail inventory and is forecasting 10 million in revenue next year, that's not going to happen unless they do something significant in terms of going out and buying juice, or to Tom's point, going out and being a negotiant and blending juice from other producers.
Perfect. Yeah. So Joe, maybe you can take it forward for now,
Okay,
and
good.
then maybe we just take after 15 minutes last question.
Okay, good. So here are the approaches and what I consider to be the strengths and weaknesses. We talked a little bit about this during the question. So, we all know what the income market and asset approach are. So I'll look at the strengths and benefits and the weaknesses and shortfalls. Like I said, the income approach is used to value a wide range of businesses where cash flows can be estimated. We have the flexibility to perform scenario analysis by adjusting projections and assumptions that meet the requirements or that meet the constraints of the company's existing inventory or their contracts on a go-forward basis. The weakness is that it's relying on management projecting, and every manager certainly has an optimistic well, it depends on what you're talking to them about, what your scope of work is, but most managers are looking at the upside as opposed to the downside. It's highly sensitive to assumptions in terms of cost of capital and growth rates, and obviously a business that has all the things being equal, if I valued it 6 months ago versus today, my risk-free rate is significantly higher. My risk of my cost of capital is significantly higher, and all the things being equal, those cash flows would be worth less. Market approach, really the biggest, it's a great approach to use. Valuing I would equate it to a level 2 input. You're valuing a business based on the sale of a similar asset. The hardest part is to get the information on them, because it's just very difficult data to get a hold of. There's also a comparability issue. So if I'm valuing a winery in Washington State, and I have multiples of EBITDA for transactions in California and Oregon, they may not be appropriate given the region, and so I need to try to get geographic data if I can for this type of approach. The asset approach, like I said, is more applicable to an asset-heavy business. It can be used to value a business with limited cash flows or earnings. In many ways, I see it as a floor of value for an asset-light business, and I also see it as a ceiling of value for businesses that have significant assets but are not generating enough return from those assets in the form of cash flows that they would generate if they were to sell the assets together as a whole. Does not capture the intangible assets. Typically, I try to value those assets using a relief from royalty approach. If I can, I try to get some information from some of the databases that have transfer pricing data that will allow me to pick some royalty rates. But I often try to reconcile those intangible values based on my conclusion and triangulating these approaches. So these examples, Pratik, if we're limited for time, I will just highlight that anybody that's on this call that's associated with valuation will certainly understand that this is a typical model in terms of what gets looked at in terms of looking at working capital and capital expenditures and identifying cash flows to invested capital, as well as a buildup of the discount rate and a sensitivity to those key inputs, in this case, terminal growth rates and discount rates. This is an income approach. This is a market approach. This transaction data is dated, and so these are actual transactions. We've put company A, B, and C to identify or to keep everything confidential. But we're looking at both a revenue and an EBITDA approach, and that EBITDA range. You can see here goes from anywhere from 7.7 to 10 times. Cult wineries go as high as 14 to 18 times EBITDA, and wineries that are in other regions that are not as active in terms of transactions may go for as low as 5 to 6 times EBITDA. But there is a high correlation between growth and multiples and margins, and so the logic holds for pretty much every industry, or for this industry like it does for every other industry, that you need to look at comparability and make sure you have strong comparability. No two businesses are alike. Make sure that you're looking at the right metric, and that metric is calculated consistently across the analysis. And as I said below, high quality asset luxury brands often sell from 10 to 12 times. Integrated luxury estates at 14 to 16. There are some that are trading at significantly higher multiples on the publicly traded markets, and that may be an opportunity to, if you don't believe in the forecast, to suggest that that's at a point of selling that stock. The asset approach is simply taking a look at the assets on the balance sheet and fair market valuing them. We're typically using the value of the inventory is much more involved. I can do a separate webinar just on valuing inventory, but effectively what we're looking at is the retail value of the inventory, assuming any costs that get associated with turning bulk wine into bottled wine, and then any costs associated with selling that wine. And so I apologize. And so I think that there is a good approach here that is more of a consolidated effort. So when I am valuing a large estate, I try to consolidate data that I get from other appraisers, vineyard appraisers and real estate appraisers, so that I can identify the long-term assets through appraisals, as opposed to an estimate that I would make, because I don't value vineyards every day, and there are people that do it well. And so but usually it becomes a cost issue. The client may not want to spend the money based on the scope of work to go out and hire an appraiser to go appraise the value of their land. But the end result is that you're going to look at a value of the equity on a fair market value basis based on all of these adjustments. A hybrid approach is really something that investment bankers use. They will look at the cash flows, and then they will look at the value of the inventory. And so, the value here is, and they'll look at the value of the vineyards and the property. Effectively, what they're doing is considering those as not necessarily non-operating assets, but asset value that's above and beyond. I take a different approach. I'm a little bit more conservative. I like looking. When I look at cash flows, I believe that those incorporate the return of those assets into those cash flows. So, for example, we talked about how a margin for an asset-heavy business may be different than one for an asset-light business. I believe those cash flows incorporate those returns on those investment or on those assets, but in some respects we get to the same number anyway. I think they'll use rationalize a lower multiple on the cash flows, and then add the other assets for an asset heavy business. In the end, we're looking at the same thing. So key drivers that drive the value of these cash flows, that drive the value of these businesses, brand fundamentals. Really, it's, we're talking growth rates, quality, reputation, margins, and the ability to scale. So the Cameron Hughes example is a really good example that as a negotiant, they can scale significantly higher. If Costco demands twice as many bottles, they can actually turn that around within a few months based on their ability to go out and buy juice on the open market as a negotiant. There are technical considerations, legal structure, accounting treatment, normalizing adjustments, like we talked about, adding back related party expenses. Some wineries have the vineyards held in a different entity, and the winery leases it back from the real estate owned business, and so that adds to some complication and considerations in terms of looking at the cash flows. We certainly look at buyer considerations when we say here portfolio gaps or white space. What we're saying here is that if a portfolio has a significant line of varietals but doesn't have a strong Pinot Noir brand, they would go out and look for a strong Pinot Noir brand to put into that portfolio and fill that gap of what they lack in terms of diversification. There's certainly scarcity and desirability of a brand. There is a uniqueness to a cult winery, whether it's a Costa Brown or other wineries that just have a strong reputation that will live far beyond the value of the cash flows that we're looking at. In terms of the opportunities for owner synergies, those are definitely considerations. A buyer would not necessarily pay a seller for the value associated with those synergies, but they may be more apt to pay a higher price than a purely financial buyer. And then there's geographic reach. So we're seeing a lot of California wineries buying wineries in Oregon and Washington to mitigate some of the climate change risk that we see in California. And there's market dynamics. There is when there's cheap debt, those deals usually happen more often. When there's dry powder from private equity firms and financial buyers, they will buy a business that maybe they may pay a little bit higher than they want to, because the alternative is to give that money back to their investors. There is definitely exchange rate opportunities. So, for example, there is an increased opportunity to buy wineries abroad now with a strong dollar, as opposed to the flip side where the dollar is weak and there is an ability of foreign buyers to buy American wineries for a relative cost that is less based on the exchange rates. And consumer demographics. And I'm going to jump to the next slide because it really deals with. Well, let me just see here. This is a triangulated approach that we talk about that I talk about all the time. I like to make sure that I use all three approaches and reconcile to make sure that my number makes sense for all three approaches. For an asset light business, that assumes that I'm looking at an implied value of the intangible assets if I'm not valuing them directly with the other two approaches. So I think this is just a fundamental approach that you need to look at in any valuation by triangulating these three approaches. And in terms of valuing businesses, it's not an exact science, and value is a moving target based on all the different variables we talked about. But one of the things I mentioned about the impact of I had talked about these market dynamics. the ability to the shifts in alternative packaging and size to combat price increases in glass, and the need to shift and the need to meet shifting demographics from millennials and Generation Z, as well as Hispanic and Black consumers. I mean, that's every marketing department in every large winery is trying to figure out what millennials will buy and what Generation Z consumers will buy. A lot of the buyers that are spending $200 to $300 a bottle on wine are baby boomers that are, you know, going away from a demand perspective, and there is a desire to meet that that younger demographic, and it's been incredibly difficult to try to understand what that demographic wants to do or wants to spend their money on. Climate change is a huge issue. Spring frost in France, from to wildfires in the United States, especially the West Coast, impact quality and access to insurance to mitigate that risk. And there's a legislative outlook that there is this bill SB 1085 that prohibits foreign government from buying California agricultural land. There is that's California. California is has a uniqueness all its own, but sometimes and most often the rest of the United States follows some of the successful bills that go into place in California. And the climate bill certainly is increasing funding on climate change. And Pratik, if I do have time, I can go through this, but do you want to answer questions first? Pratik?
Yes, I think there are like another couple of questions. So one is just a kind of query from Esther asking, are the valuation multiples from the real cases or just an illustration?
They are from real cases, so I would say that but they are pre-COVID, and so I have access to other more current data, but they haven't been vetted as much as the information that I have here. When I mean vetted, I mean that the multiples that I have in the presentation, I went through with one of the largest investment banking firms here on the West Coast that deal specifically with wineries and craft beverage. So, but those are real multiples. They're just not as current as some of the other ones. And I don't think those multiples have changed really significantly. I think that when you look at a business in the wine industry and you're looking at one that has lower profitability and maybe has a distributor model, you're looking at 6 to 8, and then as high as 14 to 16 on the cult status wine that's selling most of its wine direct to consumer at a high bottle price.
Perfect. So I think we're also running out of time. Maybe for a minute you can take it up, Joe, and then we can pass it on to Chanda.
Sure. So this really quick, if you have time, please take a look at this case study and click through these links. The San Michel Wine Estates was purchased by a private equity firm, and there's a lot of private equity money that's going into this industry because of the dry powder situation that I talked about. That there are a lot of private equity investors that would rather spend their money and mitigate their portfolio risk in this industry than give that money back. So Sycamore Partners bought San Michel Wine Estates for $1.2 million. They went out and bought A to Z Wineworks, which is one of the biggest wineries in Oregon after the fact. And they're looking to sell their Woodinville property, which is the largest winery from a facility perspective in the Pacific Northwest. So you can see that they're using some of their assets. They're trying to sell some of their assets on the production side to fund some of that debt that they had they picked up when they bought the business. So yeah, that's it. I mean, I am open for any questions via email. You have my email on my profile, and you can get it through Pratik or Chandra. Just feel free to email me. I'm very open to sharing what I do and how I do it with others. I'm a big proponent of ongoing learning, and I'm not, I don't hold that information close to my chest.
All right. All right. Thank you, Joe.
Yeah, you're welcome.
Share this one screen so we can see the next webcast. All right. Thank you, Joe. And thank you, Pratik, for today's presentation. We had it was a great presentation and we had some great questions throughout. Our next webcast will be on November 28th. So yeah, we look forward to seeing everybody there. And I hope you guys all have a wonderful week and have a great day.
Yeah, thank you for having me.